The enduring legacy of William Delbert Gann rests not solely on his complex and often misunderstood forecasting methods involving angles and cycles, but rather on his immutable and profoundly practical rules for market operation. Gann understood that sophisticated analysis is useless without a foundation of strict capital preservation and unwavering psychological discipline. These golden rules are the essential bedrock that separates the long-term survivor from the short-term speculator doomed to failure. Before any trader attempts to master the intricacies of price movements, they must first master these 7 foundational principles that govern risk and self-control. This presentation details the 7 critical rules that Gann insisted must be mastered before any technical analysis can ever be effective in the marketplace. Before we delve into the deep wisdom of these trading laws, please take a quick moment to ensure you are subscribed to the channel. Hitting that subscribe button and leaving a quick comment, even just a single word, is the simplest action you can take to help the algorithm recommend this crucial information to more aspiring traders. This helps confirm that content focused on discipline and historical wisdom truly matters and is worth the extensive effort required for production. Furthermore, please promise yourself to return to this channel and revisit this video during those challenging times when trading becomes difficult and your confidence inevitably starts to waver. The very first principle and the cornerstone of Gann's entire methodology is the absolute necessity of rigorous capital preservation. A trader must determine the precise size of their trading unit based entirely upon the total amount of capital available in their account. This systematic approach ensures that emotional decisions about position sizing are eliminated before they can ever occur. Gann enforced the stringent 10% rule, mandating that a trader must never risk more than 10% of their total trading capital across all open positions at any given time. This rule establishes a protective barrier against catastrophic loss, safeguarding the majority of the account from market volatility. The definition of the unit of trade is explicitly tied back to this risk management constraint. The unit of trade is defined as 1/10 of the capital that is designated for any single transaction or investment. This standardized unit ensures that position sizing remains consistent and proportional to the overall account equity, regardless of the instrument being traded. The critical function of this rule is to ensure that the vast majority of the trader's capital remains safely in reserve. This untouched reserve capital is vital, providing the financial resilience necessary for future opportunities and allowing the trader to weather inevitable drawdowns. Many novice traders fail because they commit too much capital too quickly, believing that larger positions equate to faster profits. Gann's rule forces the trader to acknowledge that the primary objective is survival, not immediate enrichment. By limiting exposure, the trader preserves the capacity to trade another day, even after enduring a significant string of losses. This calculated approach transforms trading from a high-stakes gamble into a sustainable, disciplined business venture. Understanding and strictly adhering to this initial rule immediately elevates the trader above the vast majority of participants who are merely speculating without a defined financial boundary. The 10% maximum exposure rule is a protective measure against the psychological urge to double down or overcommit during periods of euphoria. When a trader experiences a winning streak, the temptation to increase risk beyond prudent limits becomes overwhelming. However, by predetermining the maximum allowable risk, Gann provided a mechanical barrier against this dangerous emotional drift. This rule is not merely about mathematics. It is about establishing a disciplined habit of viewing capital as a limited resource that must be treated with the utmost respect. The professional trader recognizes that capital is the tool of the trade, and its preservation is the highest priority, far exceeding the pursuit of any single profit opportunity. Gann considered the mandatory use of stop-loss orders to be the non-negotiable insurance policy against unexpected and rapid market movements. He insisted that a stop-loss order must be placed simultaneously with the entry order, effectively defining the maximum acceptable loss before the trade is even executed. This requirement removes the possibility of hesitation or rationalization once the trade begins to move against the intended direction. The stop-loss is thus transformed from a reactive measure into a proactive component of the initial trade setup. The determination of where to place the stop loss must be based on a cold, calculated assessment of the maximum loss tolerable per trade. This maximum is typically constrained to 2 to 3% of the total trading capital, ensuring that no single trade can inflict irreparable damage to the account. The stop is set based on this fixed calculation and the technical structure of the market, never on emotional hope or the wish that the market will reverse course. This strict adherence to predetermined risk parameters is the hallmark of professional trading. Gann was particularly vehement about the necessity of physical fixed stop placement, explicitly warning against the fatal mistake of using mental stops. A mental stop is inherently unreliable because it relies on the trader's ability to execute a sale in the face of fear or panic, a capability that frequently evaporates under real market pressure. When the market moves violently against a position, the emotional impulse is often to delay execution, hoping for a minor bounce, which inevitably leads to a much larger, unplanned loss. The fixed stop-loss order eliminates this human element of weakness, ensuring that the risk is capped precisely where it was intended to be capped. The stop-loss is not merely a protective mechanism. It is a fundamental tool for defining the validity of the trade hypothesis. If the market moves beyond the specified stop level, it signals that the premise upon which the trade was initiated is incorrect, necessitating an immediate exit. Accepting the small, calculated loss allows the trader to conserve capital and redirect focus toward the next high-probability setup. Trading without a mandatory simultaneous stop-loss is not trading. It is reckless gambling, a practice Gann rigorously condemned throughout his teachings. Every successful trader recognizes that small losses are a necessary cost of doing business. But uncontrolled losses are the primary cause of financial ruin. Rule 3 addresses what Gann identified as the cardinal sin of speculation, the disastrous practice of averaging a loss. This occurs when a trader increases the size of a losing position by buying more shares or contracts at lower prices, attempting to reduce the average entry price. While seemingly logical on the surface, this action compounds risk and demonstrates a fundamental unwillingness to accept that the initial trading decision was flawed. This strategy transforms a manageable small mistake into a potentially catastrophic financial liability. The psychological trap driving this behavior is the powerful human desire to be proven right, overriding the common sense necessary for capital preservation. Instead of admitting error and taking the small, defined loss mandated by Rule 2, the trader doubles down, hoping that a market reversal will vindicate their original analysis. This compounding failure rapidly increases the total capital at risk, often pushing the account toward margin call territory or exhausting the reserve capital needed for future profitable ventures. The emotional investment in the trade blinds the trader to the objective reality of the market movement. Gann insisted upon the strict adherence to the stop-loss order, treating the initial loss as an unavoidable and necessary cost of pursuing profitable opportunities. Once the stop is hit, the trade is closed, the error is acknowledged, and the capital is freed for better use. Trying to fix a mistake by injecting more capital into a losing proposition is akin to throwing good money after bad. The discipline required to cut losses quickly is one of the most difficult skills for a trader to master, yet it remains absolutely essential for long-term survival in volatile markets. Averaging down in a losing position fundamentally violates the principles of risk management established in Rule 1. It recklessly increases the percentage of capital exposed to a single, incorrect market bias. The professional trader understands that the market does not care about their average price. It only cares about its own trend. By refusing to average a loss, the trader maintains psychological clarity and financial flexibility, ensuring that a small setback does not escalate into a devastating account depletion. This rule is a direct defense against the ego, which is often the greatest enemy of the speculator. Gann emphasized the requirement to focus all trading efforts exclusively on liquid instruments characterized by high volume and consistent activity. Trading only active markets ensures that the trader can enter and exit positions efficiently without significant price slippage. Liquidity is the lifeblood of successful trading, guaranteeing that there are always sufficient buyers and sellers available to absorb large orders. This focus on high-volume instruments minimizes execution risk, which is often overlooked by traders seeking quick profits in obscure assets. The warning against trading thin or dormant markets is rooted in the erratic and unreliable nature of their price movements. In thinly traded instruments, a single large order can cause dramatic and disproportionate price swings, creating unpredictable volatility that invalidates standard technical analysis. Furthermore, spreads, the difference between the buying and selling price, are often wide in inactive markets, significantly increasing the cost of entry and exit. High spreads can turn a potentially profitable setup into a guaranteed loss simply due to transactional friction. Active markets, by contrast, provide a degree of reliability that is crucial for systematic trading. The high volume in these markets ensures that price action confirmation is more trustworthy and less susceptible to localized manipulation. When a major trend reversal or continuation pattern appears in a highly liquid market, the conviction behind that signal is significantly higher than in a low-volume counterpart. This focus allows the trader to rely on established patterns and indicators with greater confidence. Trading active markets also facilitates the successful implementation of the mandatory stop-loss orders discussed earlier. In a liquid environment, a stop-loss is executed rapidly and close to the specified price, minimizing slippage and adhering strictly to the defined risk limit. In contrast, attempting to exit a position in a thin market can be agonizingly slow, potentially leading to the stop being triggered far below the intended price, resulting in an uncontrolled loss. Gann's insistence on liquidity is a practical measure designed to optimize execution and minimize the hidden costs of trading. Rule 5 addresses the psychological and financial dangers inherent in excessive activity. The twin mistakes of overtrading and overleveraging. Overtrading is the impulse-driven action of trading out of boredom, frustration, or the simple urge to be constantly involved, rather than waiting patiently for clear signals that meet the established system criteria. This lack of patience leads to low-probability setups being taken, significantly eroding profits through unnecessary commissions and frictional costs. The disciplined trader understands that inactivity is often the most profitable decision. The necessity of waiting patiently for high-probability setups cannot be overstated, as Gann viewed trading as a waiting game, not a constant battle. The written trading system defines the criteria for entry, and the trader's primary job is to exercise the patience required to let the market conform to those criteria. Trading based on emotion or impulse fundamentally undermines the mechanical discipline required by Rule 7. Successful trading is about quality, not quantity of transactions. Gann issued stern warnings against excessive leverage, recognizing its ability to magnify both gains and, more dangerously, losses. While leverage can accelerate returns, it also drastically reduces the margin for error, often leading to premature account depletion during minor market corrections. High leverage forces the trader into positions that demand absolute perfection, a condition unattainable in the inherently uncertain environment of the financial markets. The conservative use of leverage is paramount to maintaining long-term viability. To combat the tendency toward excessive exposure, Gann implicitly advocated for a concept similar to the Rule of 3, limiting the number of simultaneously open positions. By restricting the number of active trades, the trader can maintain focus, control, and adequate supervision over each position's risk parameters. Spreading attention too thinly across numerous trades inevitably leads to neglect, missed stop adjustments, and a lack of precise execution. Discipline requires focus, and focus is impossible when the trader is overwhelmed by too many moving parts. The foundational principle of Rule 6 is the unwavering belief that trading success relies almost entirely on aligning positions with the dominant long-term market direction. Gann understood that fighting the major trend is a fool's errand, characterized by high risk, low probability, and unnecessary stress. The primary objective of analysis is therefore to accurately determine the prevailing market bias before considering any entry or exit. This principle ensures that the powerful momentum of the market is working in the trader's favor, rather than against them. Gann provided a specific and simple technique for confirming this major bias: the high and low rule. An uptrend is confirmed by a consistent pattern of higher highs and higher lows, indicating sustained buying pressure and the market's continued capacity to absorb selling. Conversely, a downtrend is confirmed by a pattern of lower highs and lower lows, signaling persistent distribution and seller dominance. This simple visual confirmation provides an objective measure of the market's true direction, eliminating subjective interpretation. The rule issues a strong warning against the common and highly destructive habit of attempting to pick tops or bottoms against the confirmed major trend. Novice traders often seek the glory of catching the exact turning point, but this highly speculative activity almost always results in premature entry and subsequent losses. The market can remain irrational and trend-driven far longer than the trader can remain solvent. Patience dictates waiting for the trend to show clear signs of reversal, not trying to preempt the reversal based on subjective feelings. While Gann is famous for tools like Gann angles and time cycles, he taught that these methods should primarily be used to confirm the strength and duration of the existing trend, not to predict reversals prematurely. The trend is the friend, and all technical tools should be employed to understand the trend's health and potential continuation. Only when the high and low structure definitively breaks should the trader consider adjusting their bias, always waiting for objective evidence of a shift rather than relying on predictive speculation. The culmination of Gann's philosophy is Rule 7, the absolute requirement for every trader to operate with a comprehensive, defined, and written trading system. This system must encompass explicit objective rules for entry, rules for exit, precise risk parameters as defined in Rule 1 and 2, and clear guidelines for market selection as defined in Rule 4. The written plan transforms abstract market theories into mechanical, repeatable actions. Without a written system, trading decisions become arbitrary and susceptible to immediate emotional influence. The defined system serves the crucial function of eliminating emotional decision-making, forcing the trader into mechanical adherence to pre-established criteria. When the entry conditions are met, the trade is executed. When the exit conditions, profit target or stop loss, are met, the trade is closed, regardless of the trader's feelings. This mechanical approach removes the fear and greed that sabotage the majority of market participants, ensuring consistency in execution. The system acts as an external authority, overriding the internal psychological weaknesses of the trader. Gann placed immense emphasis on the necessity of maintaining detailed records of every single trade executed, whether profitable or losing. These records must include the specific reasons for entry, the predetermined exit points, and a thorough analysis of how the trade performed relative to the system's rules. This meticulous record-keeping allows the trader to objectively analyze performance, identify systemic flaws in the written plan, and adapt the strategy based on empirical evidence rather than anecdotal memory. The trade journal is the trader's most valuable asset for continuous improvement. The ultimate role of discipline is highlighted in this final rule. The written system defines the rules, but discipline is the only factor that ensures those rules are actually followed under pressure. A perfect system is useless if the trader deviates from it when fear strikes or when an opportunity seems too good to pass up. Gann taught that success in the market is fundamentally a test of character. Mastery of the self, through discipline and adherence to the plan, is a far greater predictor of success than mastery of any complex technical indicator. These 7 golden rules, laid down by William D. Gann decades ago, form a complete, timeless methodology focused on managing the core variables of risk, capital, and self. They move sequentially from the highest level of capital preservation, Rule 1, down to the detailed mechanics of execution, Rule 7. Understanding these rules confirms that the true genius of Gann lay not just in his esoteric forecasting methods, but in his profound recognition that money management and psychological control are the prerequisites for sustained success. Technical analysis, no matter how advanced, is rendered useless if these fundamental disciplines are ignored. The philosophical core derived from Gann's extensive market experience is clear. Detailed market knowledge is ultimately secondary to the strict self-control and absolute adherence to a robust written money management plan. The market will always present opportunities, but only the disciplined trader who protects their capital can capitalize on them consistently. If a trader masters these 7 rules, they will possess the necessary foundation to navigate any market cycle, regardless of volatility or direction. Gann's rules are not suggestions. They are mandates for survival in the unforgiving world of speculation. They demand commitment, patience, and humility from those who seek long-term success. We strongly encourage every trader, regardless of the technical indicators or strategies they currently employ, to immediately implement these foundational rules into their daily trading routine. Make them the non-negotiable standard by which every single trade is judged, and watch your trading trajectory fundamentally transform. For those dedicated to truly understanding the foundational thought process of William D. Gann, there is no substitute for studying his original works. We highly recommend seeking out his classic text, Truth of the Stock Tape, a seminal work that delves deeply into market cycles and the essential psychology of speculation. This book offers unparalleled insight into how the market moves and, more importantly, how the successful speculator must think and act to align with those movements. It is critical to note, however, that while the textual content and Gann's psychological insights are invaluable, the original historical charts included in early editions of the book are often of very low quality and can be extremely difficult to read or interpret accurately. Despite this minor technical limitation regarding the charts, the written wisdom contained within remains a priceless resource for any serious student of the markets. You can find a link to explore Truth of the Stock Tape and begin integrating Gann's complete philosophy into your trading framework in the description below.